Would you like to invest in one of the best business models ever created? Like the idea of collecting safe, growing, passive dividend income? Looking for a cheap stock in an otherwise expensive stock market? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing valuable insurance to customers that can't reasonably live without that protection. Insurance. What a fantastic business model. After all, most people can't afford to just replace a house or a car if catastrophe strikes. Insurance companies alleviate that burden for a small monthly fee. And those small monthly fees from millions of customers can turn into billions of dollars over time. Guess what else it turns into? Rising profits and dividends for shareholders. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Allstate Corp, which appear to be trading at a significant discount today. Allstate Corp, stock ticker ALL, is an insurance company that operates as one of the largest property-casualty insurers in the United States. Founded in 1931, Allstate is now a $38 billion by market cap insurance titan that employs more than 42,000 people. Allstate primarily sells auto and homeowners insurance. Property casualty net underwriting premiums accounted for the vast majority of the company's fiscal year 2020 revenue. Of these premiums, they can be broken down into the following lines: auto insurance 70%, homeowners 23%, other personal lines 5%, and commercial 2%. After the announcement that the company is selling off its Allstate Life Insurance Company in 2021, their primary focus moving forward will be in property casualty insurance. Insurance has long been one of my very favorite business models. It's the very definition of making money from OPM, or other people's money. Since most people can't afford to cover catastrophic loss, they buy insurance to mitigate risk. You have built-in demand for something that almost sells itself. An insurance company collects premiums up front for shouldering that risk. These premiums turn into a float and can earn significant returns during the time delay between premium collection and claim payout. This float is built entirely upon OPM. Allstate's investment portfolio, the float, is worth near $100 billion and produced net investment income of nearly $3 billion during 2020. Moreover, if an insurance company properly prices risk, the underwriting business itself can be very profitable. So they're producing profit from the core business model of providing insurance and then producing more profit from the money it collects by doing so. This 1-2 punch is formidable. It's also a great recipe for growing profits and dividends. Allstate has increased its dividend for 11 consecutive years. The 10-year dividend growth rate is 10.2%, which is solid in and of itself, but it gets even better. There's been a market acceleration in dividend growth of late. Their most recent dividend increase, announced in February, came in at 50%. This growth comes on top of the stock's market-beating yield of 2.5%. That yield, by the way, is 70 basis points higher than the stock's own 5-year average yield. And the low payout ratio of 30.5% easily covers the dividend. I like dividend growth stocks in what I call the sweet spot, which is a yield of between 2.5% and 3.5%, paired with a high single-digit or better dividend growth rate. This stock is right there. Looking at business growth, Allstate grew its revenue from $32.654 billion in fiscal year 2011 to $44.791 billion in fiscal year 2020. That's a compound annual growth rate of 3.57%. I usually look for a mid-single digit top-line growth rate from a fairly mature business like this, and Allstate delivered. Meanwhile, earnings per share moved from $1.50 to $14.73 adjusted over this period, which is a compound annual growth rate of 28.89%. I used the lower and more appropriate adjusted earnings per share for fiscal year 2020. Even then, it's still outstanding. The first few years of the last decade were great, but the business really started to to take off over the last 2 to 3 years. Recent quarters have been particularly impressive across the board. However, an insurance business can see peaks and valleys simply from the variability of catastrophes and the resulting claims. So how an insurance company looks can depend on when you look at it. On the other hand, the float smooths some of that out. A combination of margin expansion and buybacks also greatly aided their cause and helped create a lot of excess bottom line growth. The outstanding share count is down by almost 40% over the last decade, which is one of the most substantial 10-year reductions I've come across. Looking forward, CFRA is forecasting a 7% compound annual growth rate for Allstate's earnings per share over the next 3 years. That would be a serious drop in growth when compared to the last decade, but I don't think it's unfair. The last few years have been extraordinary across the board, and I'm not sure how the business can sustain that. Furthermore, Allstate is working through a GAAP loss from the unloading of the Allstate Life Insurance Company. Their near-term GAAP numbers will be lumpy from the unloading of this non-core business. There's also the float itself, which could see a performance drag if and or when capital markets become less favorable. That said, Allstate runs a very tight ship. Their property-casualty combined ratio was only 83.3% for the first quarter of 2021. Even if this lowly 7% earnings per share growth rate were to materialize over the next few years, by virtue of their low payout ratio, Allstate could still afford to hand out generous low double-digit dividend raises for the foreseeable future. Moving over to the balance sheet, the company maintains a rock-solid financial position. Insurance companies operate conservatively by nature, so this isn't a surprise. The long-term debt-to-equity ratio is 0.26, while the interest coverage ratio is over 22. These numbers are actually better than they look, as there's a lot of treasury stock from those big buybacks reducing common equity. Profitability has been improving recently and is quite robust. Over the last 5 years, the firm has averaged annual net margin of 7.34% and annual return on equity of 14.01%. Again, profitability would look even better without all that treasury stock. There really is a lot to like about Allstate if you're interested in adding an insurance operation to your portfolio, and they do benefit from durable competitive advantages that include economies of scale, brand recognition, and the float. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The very business model introduces exposure to natural catastrophes. Although insurance isn't cyclical in terms of demand, there is cyclical economic risk through the investment portfolio, and interest rates are still low, limiting the returns on the investment portfolio. With these risks known, I still believe Allstate can be a fantastic long-term investment for dividend growth investors. That's especially true with the stock's valuation being attractive in an otherwise unattractive stock market. The stock's price-to-earnings ratio is 12. If we were to factor out the one-time first quarter GAAP loss related to the non-core divestiture, the price-to-earnings ratio using adjusted trailing 12 months earnings per share is below 6. Either way, this is considerably lower than the broader market's earnings multiple. Both ratios are also off of the stock's own 5-year average price-to-earnings ratio of 12.5. The price-to-book ratio at 1.4 is below its 5-year average of 1.5, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. An 8% dividend growth rate is at the upper end of what I typically allow for, but Allstate gets the benefit of the doubt. This dividend growth rate is well below the company's earnings per share and dividend growth over the last decade. It's also not far off of CFRA's near-term earnings per share growth forecast for the business. With the payout ratio being so low and recent dividend growth actually accelerating, I see this as a very reasonable dividend growth expectation. The dividend discount model analysis gives me a fair value of $174.96. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Allstate as a 3-star stock with a fair value estimate of $103. CFRA rates Allstate as a 5-star strong buy with a 12-month target price of $140. My number is high, but I'd also argue that Morningstar's number is too low. Averaging the three numbers out gives us a final valuation of $139.32, which would indicate the stock is possibly 9% undervalued. Here's the bottom line, guys. Allstate Corp is a high-quality property casualty insurance company with excellent fundamentals and accelerating growth. With a market-beating dividend, double-digit dividend growth, a low payout ratio, more than 10 consecutive years of dividend raises, and the potential that shares are 9% undervalued, this is a stock that should be on every dividend growth investor's radar. And now for a special news announcement. Pinnacle West Capital Corporation, stock ticker PNW, just reported fiscal year 2021 first quarter results, and they were great. Earnings per share came in at 18.5% higher year over year for the quarter. With this utility benefiting from more people moving into the Phoenix metro area, it's a long-term utility winner. That's why it's one of my top 5 stocks for 2021. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.